when you purchase the real estate, so obviously it depends which type. I mean, if you're just purchasing one single unit, even if you do still purchase single units or houses, there's still lots of benefits. There's still lots of benefits in terms of using tax strategies like, let's say, Section 1031 exchange. What it means is, let's say if you're purchasing a property for 300,000, let's say like in 10 years, it went double in value. And now you're selling this property for 600,000. Sale of the house, what you can do is you can do 1031 exchange. So now you're selling the property, you're taking all the funds, and then you're buying another property. Avoid paying taxes, and then you just keep repeating and doing the same things. You're buying another property, and then let's say in 5-10 years you decide to sell it again. Whatever you make in profits, you can do the same 1031 exchange, and you just keep doing the same things, and this is how you avoid paying taxes. Another way we're talking about real estate, if again with the small properties and with the being, and obviously it works better. Let's say you decide it went up in value, you don't want to sell. So what you can do is you can refinance, you can pull the money out of the property. It's completely tax-free. And then this money, you can use it to live off, or you can buy another property. So let's say, again, we'll take the same example. The property costed 300,000. Now it went up in value to 600,000. You don't want to sell it. So what you do, you refinance, you pull out the money. So let's say you pull out like 500,000, and then you can go buy another property, or you can just take the money and live off them. And that's a completely tax-free transaction because you don't pay any taxes on the refinance. And why I love all of this is because, you know, the importance of the money, because whenever you're paying taxes, you're already diminishing the buying power. So if you're selling the property, you're paying the taxes. So if you sold for 600,000, now let's say, I don't know, you paid like 150,000 in taxes. That's if you're not in a higher bracket, but you're already losing this 150,000. So, but then when you selling doing Section 1031, or let's say if you're doing the refinance, so then you have all the money that you can utilize. And one thing I can definitely tell you is that if you want to multiply the money, if you remember I told you in the beginning, it's first you need to make money, second to keep them, and then third to multiply. The way to multiply is to use the money and then keep them reinvesting. So that's how you make and multiply the money. If you want to make money, if you want to multiply money, if you want to stop working for money, trading your time for money, then obviously you're ready. So there's these different types of investments where you can actually invest in the real estate and still receive your profits without actually doing anything for that. So that's this is what I do right now. I invest into multifamily residential units. So you can just invest as a passive investor where you give a certain amount of money and then you just collect your cash flow. It in a way works as a REIT, but REIT it's just more on the you invest through the big corporations, through the private equity. Of some of them, obviously, a lot of them already publicly traded. But that's a little bit different because if you invest into REIT that are publicly traded, so you do get a K1 with the profits, but you don't get the depreciations. So if you invest like I do in a multifamily, so the benefit is that you don't have to do anything. No one is going to call you. The tenants are not going to call you. You're not going to be responsible for any kind of repairs or anything. And at the same time, the benefit is that you are the owner as a limited partner and you get the K1, whether it's a plus or minus, and you get all the depreciations. So you get to take advantage of the bonus depreciation. So what is the bonus depreciation? You might be asking, what is this bonus depreciation? The bonus depreciation, so typically whenever you buy a real estate project, if it's a commercial project, you can deduct it over 27.5 years, the depreciation of that asset. If it's a commercial, if it's a residential, I remember what I said. If it's a residential, it's 27.5. If it's a commercial, you deduct it over 39 years. So now, obviously, you know, it's a long period of time. So when we do the cost segregation, it's when you purchase the assets, and then typically it's the engineers, special people that they go and then they perform a study of what's in this building, and then they put together a report of all the assets that can be depreciated throughout 5, 7, and 10 years. What you do, you accelerate that depreciation. Instead of depreciating over 39 years, you deduct the assets over 5 years or 7 years or 10 years. So let me just give you an example. I mean, just I guess for the uh, calculation purposes. So let's say you buy an asset of $1 million. So if we're gonna depreciate it over 39 years, so it's gonna be like 25,600 something dollars, right? But let's say now if we take this 1 million and we depreciate it over 10 years, then you can actually deduct 100,000 every year. So you see, this is where the difference. And why do you want this bonus depreciation? Why do you want to have, why do you want to be part of this deduction? Why? Because it's a deduction that you can take that reduces your income. It reduces your rental income from this specific property. Or let's say if you have other properties, it will carry over to the other properties. So, and this is how you avoid paying taxes. So in other words, let's say you invested money and now you received like 20,000 in cash flow, let's say, and in profits. So and then instead of now paying taxes on this 20,000, you take this 100,000 in depreciation that you received as a deduction, and then you see you covering this income. So now let's say you have like 5 properties like that where you received 20,000 from each and you received 100,000 in total. So this whole 100,000 can cover all this income. And this is how you're not paying money. So that's why you do want to participate in these deductions, because you can deduct the income from the rental property, from other rental properties, from other passive income. So let's say you're also an investor in some other businesses where you receive the profit of $60,000. So now instead of paying taxes there, you can actually deduct with that loss. And here's another benefit, because remember also that the real estate always goes up in value. Every year you hold this property, it goes in value. So the cash flow might go up every year as well. And I was in the situation when COVID happened, when I sold my building. That was one of the decision factors, because at that moment I was losing money. My tenants didn't pay me. I still had to pay the mortgage. And then when I sat down and calculated, okay, so that's going to happen for another 2-3 years, I calculated how much cash flow I'm going to be negative in all this time, versus if I sell at a loss and then I invested, then I can make actually much more. You see, and this is where all the strategic planning comes into the place. Because a lot of the times we think, okay, I don't want to lose today 100,000, but then you holding yourself from possibly making millions of dollars.